There's a billionaire locked inside you. The key to freedom is information. The kind of information you find here on the Money Man Report. Now, here's the Money Man. Here's Dan Frischberg.
And there is a billionaire in all of us. It's the top of the hour. Welcome to the Money Man Show on the Biz Radio Network. I'm Dr. Dani Babb, co-hosting with Dr. John Rutledge, in for Daniel Frischberg today here on Biz Radio. You can check us out streaming live on bizradio.com. And for the next 2 hours, we will be your money gal and your money guy, Dr. Dani and Dr. John. So what do we do in our day jobs that's relevant to your life? How can we help you find the billionaire in you? I'm the founder of the Babb Group. I'm a media analyst for lots of networks, CNBC, CNN, Fox News, Fox Business. John and I host a weekly entrepreneur show every Saturday from 12 to 2 on Fox Business, helping entrepreneurs find their mojo and get back their business entrepreneurial spirit and figure out what to do with their business and their life going forward. I'm a real estate analyst and author of 2 most recent books called The Accidental Startup and The Online Professor's Practical Guide to Starting an Internet Business. We are here to help you. All this adds up to a great segue for you, John. Why don't you introduce yourself?
Okay. Hi, John Rutledge, Chairman of Rutledge Capital. My day job is investing stock portfolios and doing private equity work and making television shows, along with Dani on Saturdays for our entrepreneur show, where we're trying to get people to stop waiting for the government to help them and take control of their own lives and start a business. And also wandering around the world advising governments and institutions about what to do with their money. So we're going to talk about asset allocation in the markets and what you can do to grow your wealth today.
You can reach us on the web. John's website is rutledgecapital.com, and he's on Twitter, twitter.com/John Rutledge. Mine is thebabbgroup.com, twitter.com/Dani Babb. And not only are we taking your call-ins at the number 877-777-7713, but we are also taking your Twitters. You can send Twitters to @Dani Babb. We'll take them live on air if we have a chance. And John, why don't you give us a recap of what happened in the market today?
Absolutely. Almost nothing happened today. Today was almost flat. The Dow was up 12 points at 87.63. NASDAQ flat at 1849. The S&P 500 at 940, down 2.4 points. The real action is in the interest rates, where the 10-year is now 386. The 30-year is 464 on its way to 5%. And the 3-month is still only 1 3/4, which means there's a hugely steep yield curve. And the rising rates are starting to be a concern for people all around the world because of inflation and growth. The big story of the day for the market was the jobs report. This morning we saw that in May, the economy lost 345,000 jobs during May, which is only half of what it has been over the last 6 months and half of what people thought it was going to be. Unemployment rate's up, but the big drop in job losses has made people again believe there's a recovery underway, which means the focus is on interest rates and on commodity prices.
You know, John brings up an excellent point, and I think a lot of us are wondering out there, well, where are the safe jobs besides what we advocate, which is becoming your own boss? You know, one thing that we tend to lose focus on is the areas that actually are growing, and that's education and healthcare, up about 44,000 jobs in this report. Interestingly enough, despite all the government spending, losing about 7,000 jobs. Construction is making up 59,000 jobs of the job loss report, and the service sector had the biggest drop of about 120,000 jobs. And John had an interesting report here about the people who have lost jobs, and we're seeing, of course, John, you want to talk about what the demographic looks like here?
Yeah, absolutely. Well, there were now 14.5 million people who say they're unemployed, and the unemployment statistic is very strange. It's conducted by survey. And to be unemployed, you have to actually say, I'm unemployed and I'm looking for work. 14.5 million in the household survey number, up from 7 million at the start of the recession. Adult male unemployment is 9.8%, adult women 7.5%. So I guess, Dani, women work harder than men just as...
Well, that isn't surprising.
Just as we expect. The difference between whites 8.6, Hispanics 12.7, teenagers 22.7, although my experience is it's 100% for teenagers. And unemployment rates up pretty sharply because of people dropping out of the labor force. But important to remember is we still have 140 million people working here.
It's
not the end of the world.
Not the end of the world. And it's also important to remember that the job market tends to lag behind what's happening in the rest of the market. And so we may see these numbers improve, hopefully, in the relatively near future. We do know that layoffs are slowing, which is a good thing, even though jobless rates hit 9.4% in May. And, of course, we have all the major indices pretty much about flat today.
But 3% up for the week.
3% up for the week, yeah. And what does the last 2 months look like, John?
Oh, it's awesome. We're talking about increases of more than 30%, and huge increases in metals and material stocks, in the financial stocks, in the technology stocks. Wonderful market. I think what we're seeing is the stock market and the bond market have begun to clear out, and they're smelling recovery faster than the job numbers are showing it. So the stock market has turned back up. The bond market is starting to forget about the financial crisis and think about the inflation that could be coming down the road. And it's pretty clear now that Asia's growing. Asia growing means demand for oil, demand for commodities. So commodity prices are up very sharply over the last 2 months.
John, is the bull back? The bull back in this market?
I think this is a half a bull. There are two things going on. One is the financial crisis meant there was no money or no liquidity, and the bond market essentially wouldn't give us fair prices for cash flows. What's happening is that liquidity problem is breaking through, and prices are returning toward fair value for both bonds and stocks. But there are also things happening in Washington that are reducing the long-term value of the stock market. Increases in government spending, possible inflation story, increases in tax rates, increases in regulations. And so it's a short-term good news back toward fair value, but long-term we may have trouble.
Oil prices up to about $69 a barrel today, which has some people concerned, and that's we'll touch on that a little bit when we get back and look at the adjusted inflation price of oil and how that affects you. And looking forward to having you with us. Please feel free to call us, 877-777-7713. We'll see you after the commercial break. This is Dr. Dani Babb and Dr. John Rutledge in for Daniel Frischberg on the Money Man Report on Biz Radio Network.
And dial us up if you have questions. Feel free to call us at 1-877-777-7713. That's a lot of sevens.
It's a lot of sevens, and maybe that's a lucky seven. Why don't we talk about oil here and how that's actually affecting all of you out there listening? And people are starting to see. I'm hearing reports of the crude oil prices actually affecting price at the pump. What's going on out there, John?
Well, the gasoline prices are starting to rise now, a number of weeks in a row. And what has happened is that about a month ago, the world learned that China is growing again. And the incremental growth in oil in the world is all in the emerging markets. There's just a new projection out yesterday from the Energy Agency that between now and 2020, the demand for energy is going to increase by about half, and essentially all of it is in China, India, and the emerging markets. When they grow, they use more oil. More oil in a fixed supply world means a higher price. So the price of that has been rising along with all the other commodity prices. But so have lead prices and aluminum and steel prices and lead and copper prices and gold prices as well. So the world is growing, and the world's starting to worry about inflation.
Speaking of the world, we've got Andy Roth here on Twitter asking to please give thoughts on protectionism. Microsoft's Ballmer blasting Obama for protectionism this week. Buy American and climate in a bill and so forth. What do you think, John?
Well, Andy, of course, is at the Americans for Tax Reform and is a great expert on tax policy. And Andy and I last year did a press conference warning people about the dangers of repeating the mistake from the 1930s, passing protectionist legislation and destroying the world economy. The Senate has passed a bill that has Buy American protectionist language in the climate bill. If you were in another country and saw that, you really have to retaliate with your own protectionist measures to save face with your own people. That's the way the world starts to shrink again. And protectionism and support for unions from the Obama administration go hand in hand. So I think this is the beginning of protectionism.
Yeah, why don't we let's put ourselves in the hands of our listeners here, and let's assume you've got 100 grand you want to invest in the market today. Where are you going to put it? I'll give you my thoughts, and John will give you his, and we'll see if we have some calls and some questions about it.
Absolutely. Well, first of all, most people think the lowest risk investments are bonds because they have fixed coupons. But in the world we're in today, the growth is returning and inflation is rising, and people are becoming afraid to hold bonds. The flight to quality from last year is now going away. That means the 10-year bond and the 30-year bond have both increased in yield by more than 1.5 percentage points in recent months, and that means the prices of bonds are falling. So if you were a trader, I'd suggest you short the Treasury, but for most investors, it means stay away or keep your fixed income investments very short. In the stock market, stocks have rebounded strongly from being sold off so hard, and if you're not an expert, you can capture most of that by owning the S&P 500 just by buying the SPDR. If you are willing to make some judgments and make some bets, my bets today are that the wall of money created by the Fed will force its way through the banks, and this steep yield curve, the banks are going to make a ton of money. So I own a big load of bank stocks. I own a big load of stocks that will do well when China grows, which is all the way from the China Exchange Traded Fund, FXI, to the Singapore Exchange Traded Fund, EWS, the commodities, FCX is Freeport McMoran, BHP is BHP Billiton, that's copper and coal. Those are the kind of stocks that rebound when China grows. They also all do well when inflation rises. So inflation, China, and liquidity for the banks are the three themes that make sense to me in a stock portfolio. But most of us should remember that we don't know exactly what's going to happen. So if you make bets, keep your bets modest and keep the bulk of the money in the heart of the market in the S&P, unless you really feel like you're a race car driver.
And John and I are both big fans, too, of owning companies that you know something about. I'm heavily invested in tech stocks. I've sold most of my long positions in bank stocks. Quite honestly, I'm too impatient to wait this thing out. But tech stocks, what do you think of them? I'm a big fan of Cisco, Oracle, Yahoo, eBay. Looking to Palm, the new Pre, released just today, actually, an exciting thing. They had a big debut here in Manhattan. Actually, wish I was there. I didn't know about it ahead of time. But Intel, Texas Instruments looking down for the week. Intel looking down for the week. What do you think about positions long term, short on Microsoft, Intel, chip makers, BlackBerry, RIM?
Well, Danny, of course, and I have a big battle over Pre/Palm versus Apple and iPhone, where I have a significant position in Apple that's done well for me for the last couple of years, just because of their category killers, all the way from iTunes and iPhone apps to the MacBook. But I think that the tech world is going to grow very strongly, driven especially by the huge investments in Asia in infrastructure and communications and in the education sectors.
Speaking of education, people ask me all the time, well, how the heck do I invest in an educational institution? And I'll give you some of my holdings. Capella, CPLA. It's a online university. It's doing very well in its market segment. It's a little pricey right now, but if education continues to grow at this pace and we put so much money in education, then it may well be a good long shot. Another favorite of mine is APEI, which is actually a military institution. I think it's a good long-term hold. And I like Laureate Education. How's the sector doing in general, John?
It's actually doing very well, and it's a good bellwether for what's happening in the services sector. Out of the 140 million people that are actually working today, 113 million of those people are working in service jobs. Service jobs are not only flipping hamburgers, they include brain surgeons. There are working in manufacturing today less than 12 million people in America. In construction, there are only 6 million people. So jobs rise and fall with the service sector, and the service sector rises and falls with small business. So the health of the small business economy is really what matters, and the availability of bank loans for those small business is their biggest challenge today.
We'll talk about more about that after the commercial break too. The tech rally this week being led by Cisco, Amazon, Oracle. I'm still, despite all that, a big advocate of the tech stocks in the long term. I think education and tech are where we're going to see the largest gains. Who the heck actually really knows in this market, right? Or in any market for that matter. But what we do know, John's done some research that if you missed any 10 days in the last 10 years in the market, you may have missed all of the gains potentially in that entire time period. So we want to stay in the market. Want to stay in the market?
Absolutely, stay in the market and only make a move when you feel like you have specific legal inside information about what's happening.
Right. Key being legal there, of course, and maybe we can talk about what the definition of that is when we get back. But this is Dani Babb and John Rutledge. We are in for Daniel, who is with Maria Bartiromo today doing an interview, and we will be back after a word from the sponsors. And we look forward to taking your calls. Welcome back to the Money Man Report. This is Dani Babb and John Rutledge in for Daniel Frischberg today. We have on the phone here our NASDAQ Market Intel Desk, Greg Hernandez. Greg, welcome.
Thank you very much.
Happy Friday. What's going on out there in the NASDAQ?
Yeah. Happy Friday to you. And I guess even though it's looks like there's a cold rain outside, another good week. So 12 out of 13 weeks positive for the NASDAQ composite, and up 4.2% actually this week. So fairly good things going on. And I was just looking at, it actually the strong performance seemed to me fairly broad this week. If you look at the S&P 500, it's very interesting because it looks like industrials had a very strong week, and indeed I think industrials actually wound up now going into positive year-to-date territory. So now you have 5 sectors in the S&P in positive year-to-date territory, 5 sectors in negative year-to-date territory. And then, in the NASDAQ, in the NASDAQ, of course, we always, emphasize that the NASDAQ encompasses all sectors, even though a lot of people know us for our great technology leaders. So actually, within that industrial space, in the NASDAQ 100, among the top 10 performers in the NASDAQ 100 this week were J.B. Hunt and Packer, so in the transportation and trucking industry. So it is kind of interesting to see that happen.
Greg, how do you reconcile that? John and I do a show every weekend on Fox Business, and one of the things that we get a lot is that, these trucking companies, the transportation companies, they just can't get money. And we see crude prices going up. How do you reconcile that in the market today?
It is interesting. Obviously, I think a lot of these folks would be faced with the higher fuel prices, of course. I don't know their hedging strategies and that forth. You'd have to ask an industry analyst on that, but I think that there's just folks who want to play that early economic recovery play. And I think what's been going on, if you look really at the last couple of months, obviously it makes sense that maybe financials were the best performing in March, April, and May, and that very, very steep yield curve, I guess, makes sense of that. But if you look at the folks, people have been putting money in material stocks because of a global recovery play. And maybe when you look at trucking and transportation, you're looking at more of a specific economic recovery here in the United States, and people want to be early on that bandwagon, I guess.
That's right. And of course, J.B. Hunt and PACCAR are both great, well-managed companies. J.B. Hunt's got the lowest costs in the industries. PACCAR's got those great trucks they make. If you look at the railcar shipments, there hasn't really been an increase, but they've stopped falling. And if you look at employment and all the other indicators of real growth, it's looking like the decline is stopping, and you're very gradually moving forward into what will be a recovery, certainly by the end of the year. These kinds of stocks, once there's liquidity in the market, can be a great way for people to participate in that recovery along with the materials.
Yes, and exactly. And just as I said earlier, we have 5 sectors, and I'm talking the S&P, not NASDAQ specific, but if we have 5 sectors in positive year-to-date territory and 5 sectors in negative year-to-date territory, one of those ones that has been positive now for quite a while has been the consumer discretionary. So maybe some of these folks looking at the industrial sectors are saying, you know what, I might be too late kind of coming in and putting new money into the consumer sector. And so let me look for another geared play on an economic recovery, and another one with some cyclical exposure.
These some of these sectors, as you're saying, have really been on a tear. 3 months, or the last 3 months alone, since this thing turned, the S&P is up 38%, but Consumer cyclical up 71.6%, financials 68%, materials 61%, and the conglomerates up 80%. So huge increases in after we hit that bottom in the first week in March in the stock market.
Yeah, absolutely. Yep.
We've got a question, Greg, for you from Ray DeLero. What one NASDAQ stock would you buy today?
Oh, I of course, I'm not going to make any specific recommendations on stocks. And in my, it's interesting, of course, in my here at NASDAQ, being a NASDAQ employee, I am not allowed to sell anything within a 90-day window after I buy anything. So. Of course, we have those restrictions. Everybody, of course, has to have a diversification within a portfolio. I had been looking maybe when the markets first sold off, tremendously in November and December. I was looking at some things with emerging markets exposure, and that has certainly. Done very well. I think it's interesting. I mean, for people looking for a sector, let's say that's lagging, healthcare has been one that's lagging, and so that's been quite interesting. For instance, our NASDAQ Biotech Index, which has an ETF on it, IBB, is still one of those stocks in negative year-to-date territory. And it just seems to me very interesting, the fact that I think that healthcare as a sector, it has been a laggard because of uncertainty regarding the Obama administration's healthcare plan. So maybe it makes more sense to me that the large cap pharmaceuticals would be a little bit of a laggard. But some of these biotechs with actual revenue streams and that are earnings positive, and who don't have the big cost structures of the large cap pharmaceutical, maybe it's been a little bit of a mystery to me why those have been lagging.
Well, the healthcare sector since over the last 3 months is up 19.7%, about half of the increase in the S&P. So you're right that it's been lagging. On the front half of this, though, when the stocks were falling, the J&Js of the world were falling a lot less than the financials and the emerging market stocks. So maybe they had less to recover. Everybody's talking about the Obama story, where Obama wants national health care and everybody in America has their own personal drugstore. So you end up making a lot of money there. But the turn story is clearly on the growth of Asia, on the return to growth of the U.S., and on this whole inflation story. And that's really, I think, what's showing up in these materials and cyclical stocks.
Yes,
if we look at the
absolutely.
If we look, Greg, at the complementary goods, I mean, what are we looking at here? I consider tech a complementary good, particularly with HIPAA. What do you think?
I'm sorry, you consider technology
to be a complementary good to the whole healthcare sector?
Yeah. It is. It is interesting. I mean, that's the thing within technology. We consider it a uniform sector, but sometimes it's very interesting to ask yourself what is actually going in within technology and look at some of those industry groups and what's driving them. So, for instance, in January and February, I think software was actually a strong performer, but people were looking at the defensive qualities of software. And I think it was an analyst at Morgan Stanley who specifically was in a report pointed out that actually software is defensive, and I think the market reacted to that. And then later on we saw the semiconductors and the chips maybe do a little bit better for a while. So you see, the Apples of the world are consumer stocks.
No, that's great, Greg. Thanks so much for joining us. We appreciate it, and hope you enjoy the weekend. Everyone, we'll be back after the commercial break to talk more about your money and how to grow your wealth. This is Dani Babb and John Rutledge in for Daniel Frischberg.
Welcome to the Money Man Report. I'm John Rutledge with Dani Babb. We're subbing for Dan Frischberg. So if you want to talk to Dr. Dani and Dr. John, give us a call and ask questions or participate in our discussion. The number is 1-877-777-7713, and we look forward to taking your calls.
Yeah, Yeah, it looks like we have Bruce in Dallas on the line. Bruce, welcome to Biz Radio Network. How are you today?
Good. Thanks a lot for taking my call. I had a question for John. Well, actually, two questions. I was wondering if he had an opinion on whether or not the spike up in long-term rates, if that continues, if that will also have an impact on short rates, going up. That's the first part. And the second part is that the fact that the long rates are moving up indicates to me that the Fed doesn't really have control over those rates. And if they continue to go up, does he feel that might derail the stock market? So it's kind of a two-pronged question.
Yeah, I think that's the spot on the wall, Bruce. The question: if you could determine the 30-year bond rate, you can determine the stock market over the long term. Basically, the value of a company in the stock market is the present value of its cash flows, and the cash flows go on for a very long time. So the long bond's the appropriate rate to use to think about that. The rates have been skyrocketing. From the twos at the beginning of the year, we now have 464 on the 30-year and 385 at the 10-year. When I printed off these pages a couple hours ago, that has happened so quickly as a result of a number of factors. One is there was a flight to quality last year when people sold everything else to hide in treasuries and drove their prices up and their yields down. That's clearly gone away. Those yields are now back toward what they are normally. Second is that people are now believing there's a recovery that's around the corner, or at least or even beginning now, and that's helping the rates to move upward too. But the real driver is the Fed. You're right, the Fed has no control over long rates whatsoever, and they never have. The problem is they do have control over bank reserves. And if I'm looking at the numbers for bank reserves, last September, last June to September period, there were less than $100 billion of bank reserves in the American banking system. Today there are $900 billion. They've increased reserves by ninefold, 900%. In that same period of time, customers of banks have taken $90 billion out of the bank to hold at home in $100 bills out of fear for bank failures. That $90 billion is going to come back into the bank in the form of reserves, giving us a 10x increase in reserves. Increasing reserves increases money supply and spending later, and sooner or later the price level. So people are now beginning to worry about inflation around the corner. I was in China a few weeks ago talking with a vice premier who is worried about inflation and why the Fed is flooding the market with dollars and making the dollar drop. If they're worried, we should worry too. And I think that this increase in the rates is going to push the 30-year beyond 5%. Why is that important for the stock market? The stock market has what you own when you own a company is the free cash flows of that company. They go on in principle forever. The average maturity of those cash flows is more than 25 years into the future. That means if you raise the long-term bond yield by 100 basis points or 1%, that's enough to lower the value of the stock market by 26 percentage points. So we have a recovery in the prices toward fair value from being sold too cheap. But the value of the stock market, because of this rise in the long rates and the policies happening now, is really beginning to decline. So long term, the health of the market is not very healthy at all. And I think, Bruce, you're right on target that this 30-year bond is the number to watch if you're worrying about the dollar, if you're worrying about the inflation rate down the road, and commodity prices.
Continue that question a little further. May I ask?
Sure. Sure, absolutely.
The first part of the question was whether you thought the short rate would escalate to any extent, and maybe you answered that by the size of the reserves in the banking system. By that, I think you meant that you're not going to get much of a spike in short-term rates because there's so much money floating around. Is that what you're saying?
I think what's going to, if you dig inside of the Federal Reserve to the Open Market Committee, its members are people who were trained really just like me in macroeconomics classes. They believe their job is to set the short-term interest rate, and that determines people's investment decisions. So they think they can manipulate the economy by pushing up and down the Fed funds rate. That means they thought they were easing policy dramatically for the year from the middle of 2007 until last fall. During that period, though, the bond market froze up and banks stopped lending money to people. So availability of money is much more important than its short-term price to me. The Fed is now going to be looking at the economy recovering, the dollar falling, commodity prices rising, and down the road, inflation numbers moving back up again, and they're going to be forced in their own mindset to begin raising those short-term rates. I think you'll see the Fed begin to raise short-term rates toward the end of the year, and over the period of a year or so, you're going to see the short rates back up, the 3-month bill back up at 5% like it was before this all started. So this period of low rates is really only a temporary lull in normal. Thank you.
Thank you very much.
Does that answer your question, Bruce?
I think he had beautiful answers to both my questions. I appreciate it very much.
Terrific.
Excellent. Thanks. Enjoy your weekend, Bruce. We've got Bobby on the line in Houston about buying oil futures. Bobby, welcome to the program. Looks like we've lost Bobby.
Well, that's good because I'm too chicken to buy oil futures anyway. Although what you do have to realize is in this world there is a steady increase in demand that's starting to reveal itself, which gives you an increase in the price alongside the increase in the other prices. That's why we had BHP up today, because coal prices are rising. We had Freeport Mac up today because copper prices are strong. We had Statoil Hydro in Norway up because of the oil prices. So I think the bet is on higher oil prices.
Yeah, we've got a lot of people asking questions too. You know, how if that's what we believe, what is the best way to invest in that to make some money on that belief, John? Where do you put your money?
How much time have we got for that?
We've got, wrap it up in 20 seconds. Wrap it up in 20 seconds.
Well, buy low and sell high is the 5-second answer, but you want it and put your money in front of the next wave of moves in the marketplace. And that means today, move back toward growth of Asia, growth of price level and inflation.
And I'll try to get John a little more specific after the commercial break. This is Dani Babb and John Rutledge in for Daniel Frischberg, and we are cutting to commercial now. We'll see you back after the break.